Welcome back to Faultline Finance Channel. A profound legislative tremor is radiating from Juneau, Alaska, threatening to disrupt the century-long monopoly of the Federal Reserve System. The explosive headline, circulating globally, claims that Alaska has officially rejected the Federal Reserve by declaring gold and silver legal tender. To understand why this is spreading with such extreme velocity, we must first separate sensationalism from hard constitutional law. The viral narrative across the internet asserts an absolute break from the fiat dollar, a visual of a state isolating itself from the national central banking grid. In reality, the legal mechanics are far more calculating, advanced, and systematic. The crux of this legislative shift centers on the deliberate elimination of state and local capital gains and sales taxes on transactional precious metals. By removing these transactional frictions, the state is effectively treating gold and silver not as speculative commodities, but as active liquid currency. This viral explosion is not happening in a vacuum. It is accelerating because online financial networks are highly primed for systemic instability. When a sovereign state takes concrete steps toward alternative monetary frameworks, as seen with the overwhelming House and Senate votes in Alaska, it validates a macroeconomic anxiety. The immediate global reaction is not manifested as a sudden crash of the dollar, but as an aggressive psychological shift among institutional allocators and retail investors. Volume in physical retail precious metals markets spiked within 48 hours, causing a notable supply squeeze across North American depositories. If a citizen can legally extinguish a debt using physical silver American Eagles without triggering a tax event, the foundational architecture of fiat begins to fracture. We are watching a real-time stress test of the monetary status quo. This movement converts a local legislative shift into an international referendum on the durability of unbacked paper currency. Alaska has exposed a quiet battleground. It pits the United States Constitution against the artificial frameworks established by the central bank in 1913. Investors are beginning to realize that this is not an isolated political stunt, but the opening salvo of a structural migration back toward sound money. To comprehend the structural gravity of the sound money movement, we must analyze the hidden plumbing of global liquidity. The Federal Reserve controls the international financial architecture, not merely through the domestic federal funds rate, but through its dominance over the global euro-dollar system and the provision of international swap lines. For decades, this system allowed the United States to export its inflation. When the central bank expands its balance sheet via quantitative easing, it injects synthetic liquidity into primary dealer banks, artificially inflating asset prices while systematically eroding the purchasing power of the base currency. This phenomenon, known as the Cantillon effect, ensures that those closest to the money printer benefit at the direct expense of the broader economic periphery. Trust in this paper framework is rapidly decaying on a global scale. The mathematical reality of a $34 trillion national debt, compounding at a rate of over $1 trillion every 100 days, means that true debt sustainability is mathematically impossible without systemic currency debasement. Inflation is not a temporary anomaly. It is an existential feature of an over-leveraged fiat system. When structural inflation outpaces nominal yields, real interest rates turn negative, punishing savers and capital allocators who remain entirely exposed to paper assets. Central banks worldwide are caught in a monetary trap. They cannot raise rates high enough to permanently choke off inflation without triggering a catastrophic sovereign debt servicing crisis, nor can they lower rates without sparking a massive speculative run on hard assets. This structural decay is exactly why individual sovereign states and global market participants are actively hunting for an escape hatch from the fiat regime. What does it truly mean for a state to reject the Federal Reserve? We must deconstruct this through a hyper-precise legal lens. Critics argue that state-level gold and silver legal tender laws are purely symbolic gestures, completely nullified by federal statutes and the Supremacy Clause. Under Title 31, Section 5103 of the United States Code, Federal Reserve notes are established as legal tender for all debts. However, the legal strategy utilized by Alaska and over 20 other states flips this paradigm by invoking Article 1, Section 10 of the Constitution itself, which explicitly states that no state shall make anything but gold and silver coin a tender in payment of debts. Therefore, rather than launching an unconstitutional direct frontal assault to banish the Federal Reserve note, Alaska is executing a constitutional carve-out. By recognizing United States minted specie as legal tender, the state removes the status of gold and silver as mere commodities subject to state income taxes. This transforms them into viable legal tender within state borders. The policy implications are deep and far-reaching. If a state government accepts gold coin for tax payments and establishes a state-chartered bullion depository, it creates a parallel banking infrastructure. This gives citizens a legal choice. While a single state cannot collapse a multi-trillion-dollar central bank overnight, the institutional validation of a gold-backed alternative creates an unstoppable legal precedent and a shield against federal monetary mismanagement. Precious metals are experiencing a massive structural resurgence that extends far beyond simple retail speculation. For over 5,000 years, gold and silver have functioned as the ultimate apex assets because they possess intrinsic value, cannot be printed by executive decree, and carry absolutely zero counterparty risk. The modern financial system, anchored to the post-1971 unbacked dollar standard, is a historical anomaly. As the structural flaws of this 55-year experiment become undeniable, gold and silver are rapidly reclaiming their monetary premium. We are currently witnessing an unprecedented technical and fundamental breakout in the metals markets. Silver, which has historically functioned as both an industrial vital asset and a monetary proxy, is exceptionally coiled for an explosive upward move. The silver-to-gold ratio, which stretched to historically distorted levels, is beginning to compress violently as physical shortages emerge on global exchanges like the COMEX and the London Bullion Market Association. This momentum is heavily amplified by the stark divergence between the paper derivative markets and physical spot reality. For years, institutional short positioning via synthetic paper contracts suppressed the true market clearing price of these metals. However, as sovereign entities and individual states demand physical delivery rather than paper settlements, a structural short squeeze of historic proportions becomes highly probable. Alaska's legislative pivot acts as a massive fundamental accelerant, signaling to global capital allocators that physical accumulation is no longer just a defensive hedge. It is a proactive transition into the next monetary regime. The most critical variable to monitor is not retail sentiment, but the massive, quiet realignment occurring at the institutional level. Global central banks are currently purchasing gold at the fastest pace recorded since the mid-20th century. This is not a speculative trade. It is a calculated strategic de-dollarization campaign. Under the international banking guidelines known as Basel III, physical gold is classified as a Tier 1 risk-free asset. This places it on an equal regulatory footing with cash and sovereign treasury bonds. As geopolitical tensions fracture the unipolar financial world, the weaponization of the dollar clearing system has forced sovereign nations to eliminate counterparty risk from their reserves. Institutional asset managers, pension funds, and family offices are facing an acute dilemma. The traditional 60-40 portfolio architecture, consisting of 60% equities and 40% sovereign bonds, is failing to protect real purchasing power. In a high inflation environment, we are seeing a structural capital reallocation toward tangible commodities. This rotation is triggering significant volatility across the commodity complex. As massive pools of institutional capital chase a highly finite supply of physical precious metals, liquidity pools are drying up. This leads to wide bid-ask spreads and sudden aggressive upward price gaps. Safe haven asset demand is no longer driven by temporary panic. It is being driven by a systemic reallocation looking to survive a sovereign debt crisis. We have arrived at a historic macroeconomic turning point. The developments unfolding in Alaska are a microcosmic preview of the broader global sovereign debt supercycle drawing to its inevitable conclusion. This is the monetary reset theory transitioning directly from academic papers into active legislative reality. For investors worldwide, the primary objective must shift from chasing nominal, paper-denominated yields to aggressively preserving real, purchasing power wealth. To successfully navigate this unfolding transition, investors must monitor 3 critical metrics over the next 12 to 24 months. First, track the rate of physical bullion withdrawals from Western commercial vaults versus Eastern institutional accumulation. Second, watch for follow-through legislation in secondary states, which would create an interconnected network of domestic alternative monetary jurisdictions. Finally, closely monitor the velocity of the consumer price index relative to real, inflation-adjusted treasury yields. The long-term implications for the global economy are clear. We are heading toward a multipolar monetary system, where unbacked fiat currencies will be forced to compete directly with hard, tangible assets. Those who remain entirely exposed to synthetic paper assets and over-leveraged sovereign debt instruments are likely to face severe capital impairment. Conversely, allocators who position themselves early in physical specie and sound money infrastructure will not only protect their capital, but will capture a massive transfer of wealth as the world inevitably returns to real money. If you found this deep dive into Alaska's sound money shift valuable, make sure to smash that like button. Share this video with someone who needs to understand the structural decay of fiat currency, and subscribe for more institutional breakdowns. See you in the next video.